Hi, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, the co host alongside the Stephen Thomas, chief economist and founder of Reports on Housing. So, today we will discuss the most recent economic news and statistics, where home prices are heading, concessions on the rise, home sales slamming the brakes, mortgage rates, and so much more. Typically, we just take a little snippet and we ask about each other's lives, but it looks like Steve's on a time crunch with having to see a professional NBA Ezekiel basketball game. So, first, Steven, what is going on in the real estate market with supply, demand, and our very own expected market time?
So, what is going on? In looking at the numbers over the last couple of weeks, even on a weekly basis, I'm rather alarmed at how quickly the inventory is growing. It's actually not alarming. I told you it's actually a good thing, but it depends upon where you're sitting. Now, if I was a seller, I'd be a bit concerned with how fast the market is slowing, and that is because inventory is rising. There are a lot more homes coming on the market. In some counties, it's actually almost identical to year over to prior to pandemic numbers, which is like normal numbers. Others that's still off, but it's all moving in the direction of more homes coming on the market than last year, which is way more than 2 years ago when nothing came in the market in 2023. And that's that locked in effect. That locked in effect is beginning to crumble that everybody talked about it. I called it hunkering down because people were deciding not to move because they loved their low rates and they thought that eventually rates would come back down again because that's what everybody said. Everybody said the rates were supposed to come back down, but they did not come down, and instead they've stayed the same. And people don't think that rates are ever going to get back down in just into the fives. So as a result, people are pulling the trigger. More homes are coming on the market, and the issue with that is, as more homeowners come on the market, it is matched up against very similar year over year demand. And I looked at the Bay Area demand. Actually, Bay Area demand is actually a little bit less than the last couple of years. And same thing in Clark County, Vegas was a little bit less than the last couple of years. And Phoenix, pretty close to the same year over year. And all of SoCal, pretty close. However, a lot more homes coming on the market. So you got a lot more homes continuing to come on the market, and demand peaked in almost all markets already. So if it's already peaked, it means that we're in spring. Demand will remain elevated but come down a little bit from week to week, and it is coming down. Demand's coming down, and the increase in the inventory is a lot greater than it's been before. So we're having inventories grow faster this year and demand coming down, and as a result the market is slowing from week to week to week, and it really, they're beginning to feel it in the marketplace early. This is spring. We haven't even got to summer yet. And this has a lot to do with tariffs. I'm sure we're going to get into all that stuff. But so that's overall, we're seeing it slow. And it's enough where we're going to write a report this week called Cracks. That we're bringing to you this report on April 25th. So we're recording it before the weekend. And then I'm going to write our report on Monday. And that report is going to be talking about the cracks that we're seeing in the marketplace. And the cracks are, it's just this shift of a real sluggish slowdown. Doesn't mean that values are going to crater or really come down. That is not going to happen. That is not in the cards. It does mean there will be pressure on pricing slightly. And I would want to get in, like it's like when the stock market, when you get in the stock market, when things are lower. And that's kind of what we're seeing. Before rates will eventually come down. And once they come down just to 6%, we're not even talking the fives, but just to six, it will change our marketplace. We'll absorb a lot of those extra homes that were placed on the market. So when do you want to buy? When the rates are still pretty darn good today compared to where they were a year ago at 7.5% in April of last year. And there's a lot more choices. So that's when I'd play.
And to touch on the economic side of things, what has happened over the last couple of weeks? It seems like there's a little bit less chatter following all of the tariffs.
Yeah, the less that's said about tariffs is the better. I think the administration's kind of learned that after the 90-day pause. Not saying a lot about it is very, very important. Um, and then so there is nothing really going on there. But with the economic numbers, they haven't really moved the markets either that much. We had retail sales that were a little higher than what they anticipated was, but a lot of that higher retail sales might have been people stocking up in anticipation of the tariffs, 10% tariffs and prices going up down the road. So you can't quite read that. So tariffs is kind of like mucking up everything. And we got an inflation read, and it was way less than expectations on CPI, and it was looking like that soft landing that the Fed was trying to get, and it was going to occur. And now the market didn't react. Why? Because they expected to start to rise later on this year with inflation. So we're getting all these different numbers that aren't really moving the needle much, and then we get these consumer confidence reads that don't help things, and that's where confidence is really coming down, and the overall consumer sentiment is down, and it's kind of leading people into thinking that things will really slow down and we're going to have this real soft patch in the economy. And that's kind of why we have better rates than we had during this time last year, more homes on the market, and there are buyer activity is down just a little bit compared to 1 year ago right now. And some people say that buyers might have gone on strike. I'm sure we're going to hear all that chatter from people out there, but that's not really what's happening. Consumer sentiment and the tariffs is starting to hit housing and the number of people they don't want to do a big ticket item because they're kind of nervous. That's the initial reaction. It's kind of like when we went into the pandemic, very similar when we went into the pandemic. That was that kind of reaction. You know what cures that? Low rates. If we get rates just at 6%, rates come down to 6%, that will reignite things. And we'd see a definitive change right away. So I'm not really that worried about it. It's not that the buyers are going to go on strike and they're going to wait for prices to come down. That's not what's going to happen. We're just going to eventually see where rates eventually come down and reignite things. And that's typically what happens is we get when we go into any kind of a slow period, a recession or anything like that, we typically get better rates because of it. And the better rates would come with any kind of a change in the job market along with the recession. So if we got that, that would bring around lower rates, which would cause what brings us out of that doldrums. It's the housing market, and that's the lower rates. So that's what we're anticipating.
So, on the topic of lower rates, as we've been stuck as at a standstill in the higher sixes, what can drive down rates from here? Because before, everyone was just keeping all their attention on the economic data. It was just the obviously what everyone relied on, but then so much has shifted so quickly. So, what can really drive rates down from here?
So with the Fed's wait and see attitude, the only thing that would make them stop waiting and seeing is when they see, and either they're going to watch to see what breaks first because their dual mandate is pretty much labor over inflation, those two things. And if they're watching labor even closer. So if labor were to break and we saw fewer jobs created and a lot of different things happening on the labor side of things, yeah, you would see the Fed will suddenly change their tune. It would be instantaneous. So that's what we're anticipating going forward is it's got to be a labor market thing to bring those rates down to where they would be healthily underneath of 6.5%.
Many have often spoken about the silver tsunami, but will we see an aging population giving their homes to their families more than ever, especially in places like California and New York, with incomes rising not as quick as housing prices? What is your take on something like that?
So I see where you're going here. You're one of 9 kids, and the angle is you want the house. No. So, yeah, there will be some of that. It's just going to be a hodgepodge of everything. And that dial of number of baby boomers that are going to either, go to an assisted living because they have to, or they go to the heavenly Mecca up in the sky. One of those places is where they're ultimately going to end up. So it's either we die or we go to a place and we live our last of our years at sunny side in or whatever it's called. So it's one of those things where that dial is going to be increasing over time, and in 2030 we'll see a bit of an increase to that. So we will actually get some inventory. But remember, these are older houses too, so a lot of that stuff will require some work and different things like that, which will be good for the economy once again, and it will add to the inventory that we so desperately need as more of these houses change hands. Even if it changes hands by and somebody gets to move into it, that's a millennial that'll be able to jump into a house or something like that. So uh, we'll see where all that goes, but it will be a slow dial and it will start to increase a bit in 2030, but slow moving.
Clever Real Estate reports that 70% of those asked worry about a housing market crash this year, of course. And 1 in 3 are worried they won't be able to afford their housing payments as a result of the economic climate. So, Stephen, for these people in specific, what would you have to say about both the topics, the housing crash that they fear and the unaffordability constraint?
Yeah, so it's funny that worrying about a housing crash, we show it. There's just not inventory. We have more inventory. That's the story, more inventory. But when you're looking at 1,330,000 houses on the market for all of the United States, according to National Association of Realtors, and you can compare that to where we were during the Great Recession, even prior to the Great Recession, you can actually see it coming. It's like a slow moving snail. You could see a snail moving. It's so slow, you know that snail's there, and that's how slow it is. And you can see it, and it's going to take time for that snail to make it from one side of the sidewalk to the other. That's about the pace that it goes. So you can see it in the numbers. We saw it as early as the fall of 2005 for the Great Recession, and it didn't really materialize to the Great Recession until 2007, and it hit the fan in March of 2007. And then it really didn't affect overall total economy till even later than that. But you could see it coming. And there were 4 million homes on the market. There was 3 million in the fall of 2005. Then in 2006, we just about hit 4 million. It hit 4 million in 2007. So there was plenty of leeway and plenty of breadcrumbs that showed us where this crash was going to come from prior to that even happening. And so that ultimately, you're not seeing it at 1,300,000. We're going to make our way towards 1,400,000, maybe 1,500,000 houses on the market to top out this year. That's nothing compared to 4 million. So there's just not the pressure because the number of the pending sales activity is very similar to Great Recession levels. But the difference is there's just not this gargantuan housing glut of number of homes available. You're just at 1,330,000. So there's just not going to be enough pressure on prices to cause that crash. And everybody's sitting on mounds of equity. So they don't really have to move. People are just wanting to move. And the more that comes out and where they hear that the market's really slow, that might prevent some people from placing their homes on the market after the spring is done. They'll go, yeah, I'll wait till the spring of next year. That's just the way that people that don't have to move operate. And there's a lot of people out there that fit that category where they don't have to move. And you could see a load of homes on the market in like Florida, and it gets all of the clicks on the internet as to negativity of the housing bubble crash thing that everybody's hearing. And it's just down like a little bit less than 3% annual. So that's nothing. That is nothing in a year. We're talking a crash is where it comes down 20 to 30%. And that's not what we're seeing. And it's not anywhere close to being anything like that. So that's just not going to materialize. So I don't know what people are waiting for. And the affordability side of things, eventually we will get rates that cooperate and will come down. I know that we're not talking, I'm just talking getting down to 6%. I don't even want them to get down into the fives and create a lot more affordability because I have an issue with values going up too quickly. So I would rather it just go down to 6% so that we don't have that problem in the entry level market across the United States where people are writing multiple offers and values are going up too quick. So I'm just rooting for 6% for affordability and just keep this methodical, really slow rise and to the point where incomes are rising faster than that rise. And that's the tack that I think is going to probably be the healthiest given the current circumstances.
44% of home sellers are giving concessions to buyers, so just shy of the highest level on record reported by Redfin. What does this indicate for the type of market that we are seeing?
That it's slower. When you see there are more price reductions across the United States, it's close to 36% of all homes across the United States have reduced the asking price at least once. It's the highest in over a decade. What does that tell you? It's slower. People have to reduce the asking price in order to make it happen. This isn't like the day before, where the last couple of years, where you're able to get away with maybe pricing a little bit too aggressively, and then it's still sold. When there's all this extra competition, buyers can take their time and they can pick the one that's probably the most accurate in pricing, is the ones I guess that are going to win, not the ones that are overpriced, that's for sure. And so what does it take to, if you're overpriced, maybe you have to give up a little bit on concessions. So 44% are giving concessions to buyers. That makes sense. So and nowadays, this doesn't even probably include the commissions that are paid to the buyer side of the transactions, which are done through buyer concessions. So that would be probably closer to 100% if you really looked at it with buyer concessions. But they're talking about other concessions other than paying for ultimately those concessions to buyers for the buyers to pay their agent. So 44%, that's going up, and it's entirely because of the slowdown in the marketplace and wanting to sell. You're able to, hey, you know what? I'll give you something if you buy my house. That's what's going on.
So, per CNBC, March home sales dropped to their slowest pace since 2009. As everyone knows, that time was the Great Recession. Now these two economies and the housing market are just not comparable. But Steve, how can you describe the sales environment in comparison to those times?
Yeah, that's a very clicky thing to say. Slowest pace since 2009. So yeah, the current environment is far different. It's far different. And I already said that we're dealing with very, very similar demands to the Great Recession. I've said it, but I'm not like saying that's not my headline for clicks, because that gives the wrong story, the wrong impression. And I would not want anybody to have the impression that this is the same thing and we're about to see that home values crater as a result. And Diana Olick from CNBC, that's kind of like her shtick. She talks like that all the time. She's kind of like negative on housing almost all the time. But uh, overall, the number one biggest difference is the buyer over the last 15 years has done fixed rate mortgages, put lots of money down. They've bought with great credit, and they have a load of equity in their house, and they have a ton of tappable equity, which means that if they get in a pinch, they can tap their equity and get pull money out to pay bills or whatever they need, and still have 20% equity. That's called tappable equity. So, and a number of people that own more than 50% equity in their homes, or own their homes free and clear, it's 2/3 of everybody either has 50% plus equity or owns their home free and clear, of all the homeowners across the United States. So what does that tell you? Very, very healthy. They didn't have to fog a mirror. They don't have an adjustable rate mortgage that adjusts every single month. They didn't buy the loan with 0% down. They didn't utilize fraudulent paperwork in order to get a house and get into it. They could actually afford their monthly payment. They actually have good jobs. These are the people that aren't going to all of a sudden walk away from a home. There's way too much equity in the system for them to walk away from the home. So there's just not going to be this avalanche of negative activity. I know everybody wants to compare it to it, but it was the housing arena that caused the Great Recession, and it was the financial markets that supported that with buying mortgage-backed securities that nobody should have bought because they were poorly put together with fraud and everything else. So it was just a house of cards that was built. And this particular housing market, there aren't adjustables. It's pretty much all fixed rate mortgages, and it's very low fixed rates. So where are they going? This housing market is made out of brick, or actually cement with rebar. That's how strong the overall market is compared to that one. So let's house of cards versus cement with rebar. Way different. So it's like night and day. You can't even compare the two.
And to finish today's episode, where do you see house prices heading? What direction are they going in with today's large inventory and similar demand to last year?
And that's why I'm calling it a crack. I'm calling it a crack because we're actually going to give back a little bit in prices in order to, doesn't mean all. The houses that are done really well, look really nice, are priced right, and those get tons of activity and they sell within moments. And we can still show that those properties are more inclined to go above the asking price than the ones that aren't priced right to begin with. So those that are really nice, good looking houses, they have all the bells and whistles, they have amenities, they have all of the upgrades recently, and they're priced right, fly. They still will fly. And a lot of buyers will learn this lesson the hard way. They'll write up an offer and lose. And hopefully only once. Sometimes they do it twice. Some buyers like to punish themselves and do it over and over and over again. It's like, golly, you know what? Write a good offer based upon what's going on. So that is ultimately that is the best advice. Write really good offers. But overall, where are we going to go? The rates are the rate of increase will diminish going forward. As we get out of spring into summer, there's going to be more pressure. And then as we get to the second half of the year, once we get towards August, that's where there's going to be even more pressure on pricing. We could actually see prices come down a teeny bit. And overall for the year, it'd be very flat if you looked at the start of this year to the end of the year, or maybe down slightly some markets. So you just need to know your market, know that it's going to be a little stickier.
All right. Well, thank you everyone for tuning in to another episode of Let's Talk Housing. Like usual, if you want to know what's going on in the real estate industry, subscribe today, or you can check out our YouTube, which is Reports on Housing. If you do not know that, please leave us a good review. And if you have any questions at all, just post it to any of our social media platforms, or you can email us at office@reportsonhousing.com. We just changed that recently. We will see you soon and have a fantastic rest of your day. Thank you very much.
Thank you.